Hello and welcome back to our series on what is the stock market. This time we are going to be diving into the whys. Start diving into the why does the market exist. And the first thing we're going to talk about is capital raising. Okay, capital raising is just a fancy way of saying raising money. Okay, all businesses have to raise money at one point or another, even when they're first starting, or really especially when they're first starting. So as an example here, let's say I am a budding entrepreneur and I want to open a lemonade stand. I'm looking outside, it's 650,000 degrees outside, eggs are frying on the sidewalk, people are crawling inside their air conditioners. I think, you know what, it's a great time to start a lemonade stand. But I don't have the money to start that lemonade stand. I need materials. I got to get some cups. I got to get some lemons. I got to buy some sugar. I got to get one of those big water cooler things that I can put on the table. I got to get a table. You would have to get a business license, but we're gonna run this lemonade stand under the table a little bit, so we're not gonna get that business license. But in order to do that, I've got to raise some capital. Okay, I can't sell the lemonade before I've made it, right? And I can't make the lemonade before I've bought it. I gotta have money to make the lemonade, to sell the lemonade, but that's how we get the money to buy the lemonade. So we've got ourselves a little catch-22 lemonade stand. That's what we'll call it. Also, we'll call it the catch-22 lemonade stand. All right, so we raise capital. We go out into the world and we say, hey, I want to start a lemonade stand. I need money. So that is what the companies do. They go out into the market and they go public, quote unquote. What that means is they go to the public and they say, we are willing to sell our company to the public in the form of shares. All right, you can buy a little tiny piece of our company for, $4 or $10 or whatever the price of that share is. A little tiny piece of that company. You can have a little piece of the Catch-22 lemonade stand, and it will only cost you $5. Okay, so we go public by offering all those shares to the public for purchase, and we get to keep the proceeds. Okay, obviously there's a couple little hands that go into the lemon jar to take some of those proceeds, but by and large we keep the proceeds. All right, so if we do a little capital raising, we keep the proceeds. Now we can go buy our lemons and our water and our sugar, and we can start operating our business. Okay, pretend for a moment our Catch-22 lemonade stand is thriving, doing incredibly well, and we decide we would like to open new lemonade stands on Mercury. It's very hot there. I think that the biome there would support a lemonade stand. So we are going to issue more shares. We're going to take the existing shares. The shareholders will continue to have those shares, but we are going to issue more shares. Okay, it actually dilutes the ownership from the existing shareholders. So we're going to issue more shares, and people will buy them just like before. And we will take the proceeds, and we will buy ourselves a rocket ship, fly off to Mercury, and see what we can get done in Mercury. Okay, that's another way we use markets. Okay, markets can go public and put out their initial public offering, and they can do secondary public offerings. There's also something called a reissuance of shares. That's a little bit more complicated. We're going to keep that one on the back burner for now. But let's just assume there's IPOs, which is the initial public offering, and then secondary offerings, which is diluting the initial shareholders and offering more shares up for sale. Okay, the third thing we can do is as a company is we can issue bonds. Okay, basically what this means is we come along and say, hey, we want to open some lemonade stands on the surface of the sun, and we need to borrow money to do that. Okay, we want to borrow, I don't know, let's call it $100 million. It's very expensive to get to the sun. $100 million. So we say, hey, who is willing to loan us $100 million? We will pay 6% annually, and it's basically just a loan. You're taking a loan out from the bondholders. You have to pay them interest, and then at the end of the bond term, you got to give them all their money back. Okay, if I loan you $100 and you have to pay me $4 a year for 10 years, great. I make $40, but then you have to give me the $100 back. Okay, that's how a loan works. At the end, you got to give the principal back. Okay, so we could also issue bonds, or we could issue shares, and the shares can come as an IPO, the initial share, or a secondary offering. It's a second round, or we could issue bonds, which functions more like debt. So instead of owning a piece of the company, you just have a debt that company has to pay back to you. Okay, and that is how capital raising works in a nutshell in markets. All right, next time we're going to talk about how an individual can accumulate ownership of a company covertly, so someone can sneak in and gobble up some market share of my Catch-22 lemonade business. All right, this is Matt Williamson from Sigmanomics. Thanks for watching.